Imagine building the exact machine that the entire artificial intelligence revolution depends on.
Right, like the actual foundation of it all.
Exactly. And you spend billions on research, you secure this near monopoly on critical manufacturing bottlenecks, and you post record-breaking profits that just completely crush Wall Street's expectations.
Sounds like a dream scenario for any company.
You'd think so, right? But then, the moment you announce this massive success to the public, your stock just plummets.
Yeah, it's wild.
It really is. So, welcome in. Today, we are taking a deep dive into the strange, honestly counterintuitive paradox of applied materials, or known on the market by its ticker, AMAT.
It's just one of the most fascinating case studies in the market, right? I mean, bar none.
Oh, for sure.
For context for you listening, we're looking at a stack of recent sources, including a really comprehensive equity research report, their latest SEC financial filings, and some current market sentiment analysis.
Because we really need to unpack this major discrepancy between their operational success and the market's, well, kind of brutal reaction.
Right.
So if you're following the AI boom at all, you already know the big prospectors, right? Like the software giants building the large language models.
Yeah, the ones making all the headlines.
Exactly.
Yeah.
But Applied Materials is, they're the ultimate shovel maker. Actually, no, they're the company building the factories that manufacture the shovels.
That's a great way to put it. They provide the highly specialized equipment that semiconductor companies use to physically create advanced silicon chips.
And their fiscal Q3 2026 results, which just dropped on August 13th, I mean, they looked absolutely flawless on paper.
Oh, totally. Just massive numbers.
Right. They posted $9.12 billion in revenue, non-GAAP earnings per share of $3.50, and their trailing 12-month net margin is sitting at 29.31%.
Which is huge.
It really is. I mean, they're keeping nearly 30 cents of profit for every single dollar they take in. So to understand why the market punished them, we first have to understand the structural moat they've built.
Yeah, and what's fascinating here is that the strength of their moat really just comes down to physics. Yeah, literally physics. As AI models have grown exponentially larger, the traditional architecture of a computer chip has, well, it's hit a physical limit.
Okay, how so?
So historically, you had a processor in one spot on a motherboard and the memory chips in another. But when you're training an AI, moving those massive amounts of data back and forth across that two-dimensional space, it just takes too much time.
And generates too much heat, probably.
Exactly. Tons of heat. The physical distance is literally too far, even at the speed of light.
Wow. Okay, so the only solution then is to, what, build upwards, like moving into 3 dimensions.
Precisely. And this is where high bandwidth memory, or HBM, comes in.
Right, I saw that in the report.
Yeah. So instead of placing memory chips next to each other, you stack them vertically, directly on top of the processor.
Like a skyscraper for data.
Exactly. But to do that, you have to drill microscopic holes straight through the silicon, like thousands of them, and perfectly align them to pass data up and down the stack.
That sounds like an engineering nightmare.
Oh, it absolutely is. And Applied Materials provides the crucial, highly complex packaging equipment that makes that vertical stacking even possible.
So without their machines, the physical hardware required for modern AI it can't be manufactured.
Nope. It simply doesn't exist.
That's incredible. And the research also points heavily to their EPIC centers as a major bottleneck that they control.
Yes, the EPIC centers are key.
Because we hear the term R&D hub thrown around a lot, but an EPIC center operates a bit differently in the semiconductor space, doesn't it?
It really does. So EPIC-C, which stands for Equipment and Process Innovation and Commercialization, is essentially this shared hyper-advanced laboratory.
Okay.
Building a modern semiconductor fab plant costs tens of billions of dollars. Chip makers just can't afford to halt their production lines to experiment with new manufacturing techniques.
Right. Time is literally money there.
Exactly. So Applied Materials builds these EPIC centers, which allows chip makers and university researchers to come in and test new manufacturing processes using AMAT's next-generation tools.
Before they ever even buy them.
Exactly.
Which is, frankly, a brilliant trap from a business perspective.
Oh, it's genius.
Because you lower the barrier to innovation for your clients, but by doing so, you integrate your proprietary equipment into their manufacturing processes years before a new chip even goes into mass production.
Yep. Once a chip maker figures out a new process inside an AMAT EPIC center, they're virtually locked into buying AMAT equipment to scale it.
Because the switching costs would just be astronomical at that point.
Exactly. And that's why their CEO, Gary Dickerson, recently announced plans to double their quarterly equipment production capacity by 2028. The demand pipeline for these advanced packaging tools is basically locked in.
Okay, but let's pump the brakes here for a second because this is where the paradox really begins to take shape.
Right, the numbers.
Yeah, I'm looking at the revenue data from the sources, and there is this glaring discrepancy. We just detailed this explosive exponential demand for AI hardware.
Massive demand.
But then the trailing 12-month revenue growth for applied materials is reported at only 3.33%.
Yeah, it looks strangely low.
Right. And for the 6-month period ending in April 2026, year-over-year revenue growth was a meager 4.6%. So if this company holds the keys to the AI revolution, why is their actual trailing revenue growth basically just tracking inflation?
Well, we have to remember that Applied Materials doesn't just service the AI sector.
Oh, right.
Yeah, the semiconductor equipment business covers everything from data center GPUs to the chips that, roll up your car windows or run your smart refrigerator.
Okay, so a huge variety of markets.
Exactly. And while the AI-specific demand for advanced packaging is red hot, the legacy chip markets, so standard memory, automotive, industrial electronics, they've been going through a severe digestion phase.
Digestion phase, meaning those companies overordered during previous supply chain crunches, and now they're just working through their existing inventory before they buy new equipment.
Spot on. The semiconductor industry is historically highly cyclical. So when you blend the explosive growth of the AI division with the cyclical slump of the legacy divisions, the aggregate growth rate flattens out to that low single-digit number.
Which creates a massive structural headache for their balance sheet.
It really does.
Because even though their blended revenue growth is flat, keeping their technological lead in the AI space requires billions of dollars in spending today.
Yes. And this brings us directly to the cash flow conundrum that completely spooked Wall Street in the after-hours trading session.
Yeah, the financials reveal a very stark contrast here. For the recent 6-month period, their operating cash flow was robust, at $2.53 billion.
Right, so the core business is highly profitable.
Exactly. But then their capital expenditure, or CapEx, skyrocketed year over year from $891 million to $1.281 billion.
That is a massive jump in spending.
It's huge. In evolutionary biology, there's this concept called the Red Queen hypothesis.
Oh, named after the character in Alice in Wonderland.
Yeah, the one who says, it takes all the running you can do to keep in the same place.
Right.
Well, the semiconductor equipment industry is the ultimate Red Queen environment because the nodes keep getting smaller and the physics gets exponentially harder.
So the machines required to build the next generation of chips become exponentially more expensive to develop.
Exactly. If Applied Materials doesn't spend that $1.28 billion today, they just won't have a product to sell in 2028.
That is a really highly accurate way to view the industry's capital intensity. The issue, though, is that Wall Street operates on a much shorter timeline than physics requires.
Always.
Yeah. So when CapEx rockets upward while top-line revenue growth is just hovering at 3%, the company's free cash flow gets severely compressed.
Okay, so investors who are anticipating large stock buybacks or dividend increases suddenly realize that the cash is instead being poured into concrete, steel, and R&D for factories that won't yield returns for years.
Precisely. They're paying for tomorrow today.
But it's important to clarify that they aren't in any financial distress, right? According to the balance sheet data, they're sitting on $6.3 billion in cash and cash equivalents.
Right, with total stockholders' equity of $23.9 billion.
Which is just a fortress balance sheet. They can easily afford the capital expenditure.
Oh, absolutely. The market isn't reacting to bankruptcy risk here. It's reacting to valuation. Investors are asking themselves how much they're willing to pay today for cash flows that are being deferred to tomorrow.
Valuation really is the linchpin of this entire paradox. Let's look at the pricing metrics. Over the past 52 weeks, the stock delivered an astonishing return of 181.29%.
Incredible run.
Yeah, and at its recent close of $534.54, the stock carries a price-to-earnings ratio of 51.15 and a price-to-sales ratio of roughly 15.
Now, for a software-as-a-service company with 80% gross margins and zero physical inventory, a 51 PE might be justifiable.
Here.
But for an industrial hardware company that relies on complex global supply chains and massive physical factories, a 51 PE is almost unheard of.
It means the market has basically already hit fast forward and priced in years of flawless compounding growth.
Exactly. We need to unpack the mechanics of that PE multiple. The multiple isn't just a mathematical output. It's really a barometer of market psychology and certainty.
Right.
Historically, an industrial tech company might trade at 15 to 20 times its earnings.
Okay.
When investors decide to pay 51 times earnings, they're accepting a massive premium because they believe the future earnings will grow so rapidly that the premium will quickly pay for itself.
But this introduces the risk of multiple contraction.
Yes, huge risk there.
Meaning the company's underlying business doesn't even have to fail for the stock to crash.
Exactly.
If the market certainty wavers, like if investors decide they only want to pay 25 times earnings instead of 51 times, the stock price just gets cut in half, even if the actual earnings remain exactly the same.
Right. You are entirely at the mercy of market sentiment at that point.
That sounds terrifying.
It is, and that's the exact vulnerability we're seeing play out. The technical data in our sources illustrates this tension perfectly.
Let's hear it.
Well, the stock hit a 52-week high of $739.67. But at the recent close of $534.54, it's already drawn down 27.7% from that peak.
Wow. Okay.
The market is actively debating whether that 51 PE is actually sustainable.
And the moving averages tell a really compelling story about this tug of war, too. The stock is currently trading well above its 200-day simple moving average, which is down around $386.
Right.
And the 200-day is generally viewed as the baseline for institutional investors, right? Like, as long as the price is above it, the multi-year macroeconomic uptrend is still considered intact.
Exactly. It shows long-term strength.
But the price has actually slipped below its 50-day moving average of $558.
Yeah, and the 50-day moving average is the pulse of short-term momentum.
Ah, okay.
When a stock falls below it, it signals that the immediate buying pressure has exhausted itself. Institutions might still believe in that 2028 capacity narrative, but retail and momentum traders are stepping back.
So when you combine a sky-high valuation multiple with a breakdown in short-term price momentum, the market becomes incredibly brittle.
Highly reactive.
Right. It becomes highly reactive to even the slightest hint of friction. Which brings us to the sentiment analysis in our sources and how Wall Street is currently handling that brittleness.
Yeah, the analyst ratings are deeply divided right now.
You have heavyweights like UBS and Stifel holding firm with buy ratings, projecting price targets all the way up to $740.
Right, they're clearly looking past the current CapEx squeeze.
Yeah, focusing on the long-term dominance of those ePIC centers and HBM packaging tools. They really believe the multiple is justified by the terminal value of the company in an AI-driven decade.
But then, on the other side, we have firms like Erste Group, who recently downgraded the stock to a hold.
Okay, why a hold?
Well, their rationale relies heavily on the valuation concerns we've just been discussing. They acknowledge the underlying quality of the business, obviously, but they argue that a lot of the anticipated AI tailwinds have already been aggressively pulled forward into the current stock price.
Makes sense. And then there is the wild card.
Oh, the wild card.
The research notes an unconfirmed rumor swirling around the trading desks that Michael Burry, the famous contrarian investor from The Big Short, has actually taken a short position against Applied Materials.
Yeah, and we really have to approach this carefully. The research explicitly states this is unconfirmed and speculative.
Right, entirely a rumor at this stage.
Exactly. Institutional investors do not typically broadcast their short positions until they're required to by regulatory filings. Operating on unverified rumors is dangerous.
For sure. But the analytical value here isn't really about confirming Michael Burry's portfolio, is it?
No, not at all.
It's about analyzing why the market is so eager to believe the rumor in the first place.
Exactly. It functions like a structural stress test for the stock.
Right. When your stock is trading at a 51 multiple, your entire valuation rests on a foundation of absolute unshakable confidence.
And the Burry rumor acts as a tremor.
Yeah. It doesn't actually matter if the tremor caused a crack in the foundation. What matters is that the moment the rumor broke, everyone in the market immediately looked up at the ceiling to see if it was going to collapse.
That's a great analogy. It proves that the investors holding the stock know deep down just how stretched the valuation really is.
It's like everyone is at a great party, but they're all secretly eyeing the exits.
Pretty much. Short sellers don't typically target companies like Applied Materials because they think the company's going bankrupt. They target them because they anticipate that multiple contraction.
Right.
If a short seller believes that the AI infrastructure build-out will take longer than expected or cost more than expected, they know the market will aggressively reprice that 51 PE downward.
So the sheer existence of the rumor kind of validates the bear case that perfection is priced in, and, well, perfection is rarely achieved. So we have the bull case anchored in the undeniable physical necessity of AMAT's packaging tools for the AI revolution. And we have the bear case anchored in massive CapEx spending, flat trailing revenue, and a wildly stretched valuation.
Yep, those are the battle lines.
For anyone analyzing this space, what is the ultimate turning point here? What metrics will actually decide who wins this tug of war over the next few quarters?
Well, the most immediate metric will be their Q4 2026 guidance. Management has projected $10.25 billion in revenue and $4.02 in earnings per share.
Okay.
This represents sequential growth and actually topped the initial street expectations.
But because they're on that expectation treadmill with a 51 PE, just meeting that guidance is essentially treated as a failure, right?
Yeah, unfortunately, that is the burden of a premium valuation. To reverse the short-term momentum breakdown, they don't just need to meet that $10.25 billion target, they need to shatter it.
They have to prove that the AI demand is finally large enough to overcome the cyclical drag of their legacy automotive and industrial markets.
Exactly. And secondly, analysts will be watching the capital expenditure trajectory like hawks.
They need to see the Red Queens slow down just a little bit.
Precisely. If they can show that the heaviest phase of their capacity build-out is stabilizing, it will signal to the market that free cash flow is out to recover.
Right.
If, however, revenue growth remains sluggish while CapEx continues to climb, we will likely see further multiple contraction, regardless of how strong their long-term moat is.
Which leads us to the final verdict provided by the equity research report. Looking out over a 3 to 6 month horizon, the assessment scores the stock a 5 out of 10, a strict neutral rating.
Yeah. And the rationale behind that neutral rating perfectly encapsulates our deep dive today.
How so?
Well, the fundamentals of the company are phenomenal. They have a fortress balance sheet, a near monopoly on critical next-generation manufacturing techniques, and deep integration with the biggest chip makers in the world. But the price of admission is simply prohibitive right now. It's an exceptional company navigating a treacherous market environment where any minor delay in legacy market recovery or any overspend in factory build-outs is just going to be punished aggressively.
The ultimate takeaway for you, the listener, is recognizing the distinct line between a company's operations and its equity.
That's the key.
Applied Materials is a world-class operation, literally building the physical architecture of the future. But at $534 a share, it might currently be a mediocre investment vehicle simply because all the good news of the next 3 years is already baked into today's price.
Yeah, perfectly said. And as we wrap up our analysis, I think it's really vital to zoom out from Applied Materials and look at the broader implications for the entire technology sector.
Okay, what are you thinking?
Well, we spent a lot of time today discussing the eye-watering capital expenditure required to build the hardware layer of artificial intelligence.
Oh, yeah.
Applied Materials is bleeding cash today just to build the machines that build the chips.
Right, the shovel makers are finding out that the shovels are incredibly expensive to manufacture.
Exactly. And that raises a profound macroeconomic question.
Which is?
For the last decade, Wall Street has been conditioned by the software-as-a-service model. Tech was supposed to be asset-light, infinitely scalable, and high margin.
True.
But if the physical base layer of the AI ecosystem is this incredibly capital-intensive, what does that mean down the line for the profit margins of the software companies relying on this compute?
Oh, wow. That is a staggering thought. If the hardware providers are getting squeezed by the sheer physical reality of building these systems, those costs are eventually going to get passed up the chain to the software developers.
They'll have to be.
The entire tech sector might be drastically underestimating the heavy, physical, real-world cost of sustaining the AI revolution.
It really suggests that the economics of AI might look a lot more like traditional heavy industry than the high-margin software businesses we've grown so accustomed to.
That is a brilliant angle to chew on as we watch this super cycle play out. Thank you for joining us for this deep dive. Take these concepts, look under the hood of those valuation multiples, keep questioning the physical reality behind the hype cycles, and we will catch you on the next one.